Bring that ass back like a boom, 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 boom.
Alright everyone, this is Supernova and you're with Boom Traders Weekly Overview for week number 20th, May 22nd. And as usual, let's start with the session overview. We have the risk fast, tactical trading environment, current market conditions, and then we're going to do a summary. So nothing really has changed since last week. We have everything pretty much on negative since the 22nd of November last year. The general market, up, down volume, new highs, new lows, stock participation, everything is negative. And the tactical trading environment, which relates mostly to how we trade stocks, especially breakouts, is on red, meaning that the breakouts are now working well and maximum caution is advised. Now, since we've gotten this out of the way pretty fast, let's move to the current market conditions. And first, as usual, we're going to take a look at the indices, advanced decline lines, new highs, new lows, so you see what is underneath the signals that I just mentioned. And I have a couple of notes. We have the industry group sentiment and summary as usual. So let's first start with the markets. So, looking at the markets, this is my usual layout. We're looking here top left at QQQ, then we have the S&P 500 here at the bottom left. Up right is the IWM small caps, and then we have Dow Jones Industrials. And underneath them you will see this blue line is the advanced decline line, and right here with this histogram we have the 52-week lows and 52-week highs. So if we have red, just like you see right here, that means that more stocks are making 52-week lows. Then the stocks that are making 52-week highs are these ones in green. And for the last, that's since November, December last year, we haven't had much green in general. Now you can see the advanced decline line is dropping fast and furious. And what is really interesting to note here on this graph is that the advanced decline line from the COVID crash, this is the COVID crash right here, when Nasdaq reached 160 about, the advanced decline line was standing at minus 11 to 12,000, and right now we are at minus 39,000. Price still hasn't dropped even halfway through what was in COVID. So although we're still about 30% from the top of the Nasdaq, I think that there's still more downturn to Nasdaq, or at least that's what the advanced decline line is suggesting. And if we are looking at pure in terms of what the graph is showing, this is the normal chart of the Nasdaq. We have here volume showing up right here. We saw some increase in volume. We did test this low right here, but we were unable to close below it. And now if we're looking at the markets right now, it's showing futures pre-markets are opening a little bit higher. Now if we can draw a trend line right here, you will see that we are still far off from where this might find some support, and on a horizontal basis there's still some space to go, and that's just simple technical analysis, which you can see we're looking at 267, 260 for some support around those two lows. If you're a fan of Fibonacci retracements, we have to go all the way back here to actually find some pivot to draw the Fibonacci retracement, and you will see that there is some confluence of zones around the 260 zone right here for the Nasdaq. I'm not going to go into much technicals. I mean, definitely it's a bearish trend. Now, in terms of extensions from this high right here to this low, it's pretty much the same as from this high to this low. So this is another reason we might be seeing a bottom right here. But this is most likely just a short-term bottom. Then we're going to looking for some rally, maybe a couple of points right here, maybe testing this 305, 306 zone, and then I'm thinking another leg down, but that's the markets. Now let's go back to the advanced decline line and look at the S&P 500, which is performing much better. As you can see, the advanced decline line of the S&P 500 is, and here's something messed up with the graph. Let's see if I can bring it back. So Yeah. So looking at the advanced decline line, you can see this is the COVID low right here, and we are two times above that on the advanced decline line on the S&P 500. So nothing like the Nasdaq. Same thing with the price. So price is pretty much reflecting what's happening here, and you can see here at the bottom, in terms of 52-week highs and lows, we have had this red dominated tape since, what was that? That's the end of April, unlike the Nasdaq where we saw that being the case from late last year. Let's just move to the chart of S&P 500. I want to show you something there. This trend line, same as with Nasdaq, but this time we respected it. We bounced right here, and if we're looking for retracements on the Fibonacci and taking this pivot low right here, which is pretty much the most extreme low in the prior trend. If we take this pivot low right here and we extend it to the highest point of the S&P 500, which was the 4th, 5th of January this year, you will be looking at the 61.8 retracement right here. So I like it because there's volume coming in right here at the bottom. However, the volume is not as high as we had right here on this support zone of the double bottom, which doesn't really look good. And also you have to understand that for the entirety of the Friday session, the market was pretty much in a sell-off situation. Last 2-3 hours there was some volume to pick it up. And as I said, with the QQQ chart, it seems like we might continue with the snapback rally today, but it's still pretty early for the future, so it's up to see. Now let's take a look at IWM and this is a small cap. You know, they're really the weakest part of the market, and when we have a bear market, that's the first thing that is being sold. So advanced decline line is again suggesting lower lows. As you can see right here, this is the COVID. This is the COVID crash right here, and the advanced decline line was higher than it is currently standing. So there's not a lot of support from stocks for this price, and I'm expecting this to go lower. The 52-week highs, 52-week lows, pretty much same thing as with the Nasdaq. Actually, a little bit earlier than the Nasdaq, but second half of November last year, this just turned, and we've been seeing very little positive action since then. Nothing really has changed. Yep, on Friday we didn't actually undercut the low as we did on the S&P 500 and the QQQ. There was some volume, and let's just switch to regular chart of IWM. There was some volume coming up right here, but you can see volume was lower than this node right here. So I think this was just short term, and I'm expecting this to roll over and pretty much die. Last but not least, Dow Jones Industrial. I don't really look at net new highs, net new lows right there, because they're just a couple of stocks in the CTF, well, 30 to be exact, but in the CTF. And in terms of the advanced decline line, it's actually holding pretty well. It's been in this channel for quite some time, since that's last year, April. So it's been doing relatively okay. Price is suggesting that we're seeing weaker action, but the advanced decline line is not supporting this. So I'm thinking that if you're thinking something long, you might be better off looking at the Dow Jones Industrial stocks. So let me just look at the VIX, and what we noticed here, VIX tried to go up on Friday, was rejected, but the worrisome trouble here that I see is that the S&P 500 could not even get to the midline. These are the Bollinger Bands, could not even get to the Bollinger Band. So definitely trouble in paradise. And with this, I will not be talking more about charts and stuff like that. Let's just take it to the notes, because there are a couple of interesting macro things that we need to look at. That we might be determining what the market outlook will be for the next couple of months up to a year. Now back to the presentation. Let's continue with the notes. I have a couple of things that I want to take a look at. The first one is the consumer debt. Then we have the number of IPOs, then the 3 month versus 10-year yield, and the correction or recession. That's the question that's been asked by a lot of analysts, and the verdict's still out there. Some are saying yes, some are saying no, but let's look at the charts in just a second, so you get a better understanding. Now, the first thing I want to mention is, as I said, the consumer credit, consumer debt, and we are hitting the highest all-time in terms of that figure, over $40 billion in consumer credit. So basically, what's happening right now is that the COVID money are gone, forgotten now, and the effects of inflation and the printing of money by the Feds is pretty much taking its toll. So people are not able to cope with the elevated prices of food and gas. We saw that energy inflation hit 30% last month, year over year. And what is really worsened here, and you saw it basically with the earnings of Target and Walmart, is that people are cutting off their spending because they're struggling to pay things like rent, things like credit card and stuff like that, and they have to dig deeper into the plastics pretty much. And that's of course bad for equities. That means that there's not enough cash to go into investments, there's not enough cash to go into stocks, crypto, you name it. And that is one of the reasons for the recent sell-off. So basically, people don't have the disposable income to invest. I mean, it's as simple as that. And if you're familiar with Maslow's hierarchy of needs, I didn't even put it here, but I've been talking to a couple of friends that are heavily invested in crypto. And they're like, what's going on? I said, well, if people don't have food, if people don't have the money to pay rent, the money to basically secure the basic needs that a human person needs in order to live okay. I don't even need to say to live well or to live rich. If people don't have the money to secure their basic needs, they're not going to be investing in whatever it is. So for me, that's one of the most logical ways of thinking about that. Now, the second thing that is telling us that the market conditions are not right, they're not okay at the moment, is the number of IPOs and the amount of money that they're bringing in. As you can see, this is a quarter over quarter comparison for the last 7 years. And after the explosive growth in quarter 2021, the first quarter of 2021, we're going back still higher than 2020, quarter of 2020, but this is like 1/4 of the money we sold in 2021, and I think that this is only going to go lower. Like second quarter is still not complete, but it will be interesting to compare quarter two to quarter two for the IPOs, and I'll definitely bring that statistics as soon as it's out. But this is just another metric that is showing you the risk in the markets right now. As far as the 10-year versus the 3 month, I just don't understand this being a real metric of market crashes. Yeah, 2020 here's like the COVID crash that was inverted, but all this talk about this yield curve being inverted and that telling us that the market is going to pretty much die. I just don't see it happening. I've looked for the last 20 years and I don't really think that there is that much of a correlation that people try to make it out of it. So if I were you, I'd just not pay that much attention. I put it here because there's recent talks about it, this going back to inversion, and right now it stands at 1.75. I don't really see how this is going to get inverted at all. So let's move on. Now onto the topic of correction versus recession. This is a chart from JP Morgan, and this is how usually corrections go. You can see it's 2 to 1, the ratio for corrections that go without a recession. So we had, since the World War II, we had 36 number of corrections is in the S&P 500, and you can see that 12 of them were in a recession zone and 24 were in a no recession zone. Now, if we are not talking about corrections and recessions, what I want you to notice right here is that if the market was bearish, doesn't matter if there was a recession or no recession, the median return was minus 36% for recession and minus 28% for no recession. So it's pretty close. I mean, this is like 8% difference, and even less when there's no bear market. So if you have a correction and we don't have a bear market, you can see that we had five conditions when there was a recession. The median return was minus 15%, and 20 occasions when there was no recession, median return was 13%. Right now, the S&P 500 is, let me just look at the chart and tell you, regarding the futures right now, year to date, the S&P 500 is minus 17.18%. Now, have in mind that right now the S&P 500 is gapping 1.11% to the upside in pre-market, and that's the futures. So, I think these numbers are pretty close, and we are hitting, we are getting higher than the no bear market territory. As you know, that some analysts already called it as a bear market because it dropped 20% from the high. We've been on a sell signal since November of last year, so that's not really a surprise. But there's still some time to go to 28% if we say that there's no recession, and pretty much the same drop that we've experienced, almost to the downside again if we say that there is a recession. So at least from this chart, it looks like there is more downside in terms of statistics. Another one that I was looking at is that we've had 499 trading days since the previous 10% S&P 5 correction, and as you can see, this number tends to gravitate around the higher 800s, lower 900s. Well, there are some extremes like here between 99 and 20, but on general, we're looking for something like 800 to 900 days. And we're still not there. So there is some, there is some time more that needs to pass. One last thing I want to point out here, speaking about the declines, is that if you're looking at this chart, the more it declines, basically the S&P 500, that's since 1945, so Second World War, the more that the S&P 500 declines, the more time it takes to recover. So we've had only 3 declines with more than 40% since 1945, and the average decline was 51%. And it took 23 months to go there, basically to decline with those 40%, but it then took twice as much time, even more, 58 months to recover. If the decline is more modest, between 20 and 40%, it takes on an average 11 months to get there, and it takes on an average 14 months to recover. Now, we want to stay within the 10 to 20%, so this 20% pretty much is very important because, as you can see here, the average length of decline is 4 months, and then the average time to recover is 4 months. So we're looking at the end of year, September, October, as time that we might recover if we're looking for a 20% downward. And of course, we're past this 5-10% decline, so we're not even looking there. But we are really hoping to stay here, else we're looking at something more like 11 months down, basically till the end of the year, and then another year to recover or so. So that's what I have for you in terms of my notes. Now let's look at the industry groups that are showing some relative strength and the ones that are dropping below, and then we'll talk about sentiment. All right, so looking at what's strong and what's not, as usual, we're gonna go with the Market Smith Flow 250 list, which actually contains 300 stocks, and we're gonna focus on this column right here, which are the additions to this week's list. So let's just look at the categories, and we see here we have 3 stocks from the oil and gas United States exploration and production. And if you look at the stocks themselves, this is ESTE, PDCE, and SM Energy. We have two for oil and gas transportation. We have two for mining and metal ores. This is Rio and Tech. We have four in medical biomed biotech. This is um, Halo, Ions, PCRX, UTHR. Three from Finance and Right, Energy Solar. We have three. This DQ and Phase JKS. And I'm seeing some computer software coming back into play. This computer software, medical, gaming, software database, software financials. But in general, computer software is coming back. So this looks like the strongest segment right now for this week additions. And now let's look at deletions. So basically, these are the weak groups that are taken out of the list. Um, let's just look at something that has repeated itself. So retail discounts variety BG, DG, DLDR. Not really a surprise here. We have food packaged dropping. It's been a leader for some weeks now. Well, I mean in the top groups, not really a leader, but we're seeing here that food package is dropping. Food confectionery is also dropping. Finance right, four stocks dropped. Electronics, semiconductor also dropped. What else? What else? We have beverages, alcoholic, aerospace and defense. LMT actually had a pretty bad week. Tried to break down pretty much from its basing structure. And last but not least, let's look at the RS line at the new high. This is a very important metric. Basically, it's the relationship between the stock and the market. So even if the market is dropping, but the stock is dropping less, the relative strength will be making higher highs because the stock is stronger comparatively to the market. So this is a very important metric to look at, and these are the stocks that are making new highs in terms of the RS line. And in the terms of the groups that these stocks come from, this is the important part that I like to look at. We're looking at, you can see right here, utility, diversified, utility electric power, oil and gas exploration, oil integrated again, medical, a lot of medical stocks making new highs relative to the markets in terms of relative strength. As I said, some computer tech, computer software is coming up, chemicals, and that's pretty much it. So the two or three major groups that I'm seeing right here standing out, we have medical, a lot of medical companies making new relative strength highs, oil and gas, of course, and some utility diversified, utility gas, electric power, and diversified. So these are the three major groups that I'll be looking for to find some stocks that I can be actually trading. So looking at the sentiment, we recorded a historic low last week in the AI bulls versus bears sentiment reading, and I've put here the S&P 500 line graph on top, and you can see pretty much every time we had a bottom, we've had a negative reading of minus 27, 28, or so forth. So pretty much every bottom is accompanied by a lot of bearish sentiment. And last week we had minus 42.91, which hasn't even happened in the COVID crash. At the COVID crash right here, you can see at the April reading was minus 28. 90 minus 29, but minus 43, almost it's a historic low for this indicator. So this is how the sentiment goes, and as you can see, the historic views, one year bearish high was reached on the 27th of April. So a month ago we had this 59.4 bearish reading. Right now we're looking at the 50.4 bearish reading, with 26 being bullish. In terms of CNN fear and greed index, we are now at 11, which is the extreme fear, and this is usually a contrary indicator showing us that there might be some bottoming process forming, especially when we're talking about sentiment. And Bitcoin, pretty much the same thing. We saw that horrendous drop of pretty much $10,000 in a week or so, from 40 to 30. So right now we're holding about $30,000, but that was pretty bad. So let's look at the summary. Risk vest, again, negative setups. There are some, we'll be talking about the watch lists in our analyst channels on the Discord. There are some stocks that are trying to set up. The market's definitely in a markdown. Put volume is elevated, volatility is elevated, and there's some earnings. Still some earnings coming up, although this is going down and not good. The rates, we're expecting another rate hike. Inflation, of course, that's the main problem. Consumer debt is soaring, and the war now with Sweden and Finland making bids to join NATO, and Russia saying that there will be a response to that. So cash is definitely king, especially with this volatility. I think that you should be majorly invested in cash. Remember, cash is a position, and if you're taking some trades, be fast, take profits quick, and definitely try to use a very, very tight stop loss to protect your capital. So I hope you liked. I hope you liked the video. I hope you liked the overview. If you did so, please subscribe, like, and of course, come join us in our server in Discord, where we can talk a lot more about the markets. Till next week, bye bye.